Alright guys, so I'm going to show you recent trade which I did, which is selling covered calls on my Facebook shares. So first of all, I own shares in Facebook. If you have followed my value momentum investing course, you know that Facebook is a great company, and once it's at a discount, I accumulate it and then I sell it if it's really overvalued. So currently I purchased Facebook shares at a discount during the recent sell-off over here. And when it reversed into an uptrend, when it broke above the 50 moving average and made higher highs and higher lows, I started accumulating more shares over here, right? So I bought the shares here, and currently the shares are at about 172, right? So I've already made pretty good profits from here to here. So I'm already in the money, all right? But I can see that currently the share price is finding a bit of resistance at 172, and the overall market is kind of like selling off right now. So the entire bearish sentiment is causing Facebook to kind of like go sideways or even slightly down. So what am I going to do now? I can just hold on to my Facebook shares because I know in the long run it's going to go up, but while I'm waiting for it to go up, why don't make some money in the process? So I think in the next 30 to 45 days, I don't think that Facebook is going to go up very much. I think it's going to go sideways for the next 30 to 45 days. So I don't think it's going to go to $180, all right, because of this resistance over here. So what did I decide to do? I decided to sell the call options at the 180 strike, right? So I sell call options at the 180 strike. So by selling these call options, what happens? That's right, I collect premium. I get money up front, right? And what happens is that in 30 to 45 days, if the price goes sideways, the price goes down, and the price goes up, but it doesn't go up very much, if it doesn't go up far beyond 180, what will happen? These call options that I sold would expire worthless, or they will not be exercised by the buyer of the call. And what happens when they expire worthless? Best case scenario for me, I get to keep the premium for free. All right. Now, again, what happens if the price were to go up way above 180, right? Goes to 182 or 183. Then these call options, they go in the money, which means that now, remember, when I buy a call, I have the right to buy the shares. But when I sell a call, I'm obligated to sell the shares to the call buyer. So this means that if the share price goes up to 183, 185, what happens? My shares get called away. I'm obligated, I've got no choice but to sell my shares for 180 to the buyer of the call. But that's fine. Why? Because I already bought it at a lower price. So by selling it at 180, I already make my profit. I'm fine with that. Plus, I get to keep the premium. So you can see that again, selling covered calls is a win-win scenario. It's a no-lose situation. Of course, the only thing that you miss out on is that if the price keeps going up, you miss out on the potential upside. But that's fine, because if my shares get called away, I simply use the cash to buy the shares back. Remember, if you are forced to sell your shares, it's called away, your shares will disappear from your account. But the money will appear in your account from the person who bought the shares from you. So you can simply just use that money and buy the shares back. No worries, right? So yeah, so I can show you right now. Now again, you can execute the trades on any broker. I just executed it on Interactive Brokers, where I keep my Facebook shares. So I'm just going to show you where it is. Okay, so you can see that I own, first of all, here we go. I own 100 shares of Facebook, right? Facebook, I own 100 shares, okay? And then I sold the call over here. So I'll just click on that to show you. Yeah. So I sold the April 18 180 calls, which means that these calls expire on the 18th of April. And right now it's the 8th of March. So it's roughly in about 40 days, 40 to 45 days, right? It's going to expire in 40 to 45 days, right? So I sold the calls And what price did I sell it at? By the way, I sold it yesterday, right? I sold it at, you can see my average price was, there we go, $229.21. So about $230, okay? So in other words, $230 has been credited into my account. But when you look at it, it depends on a broker. Like for interactive brokers, it shows a negative, right? So it basically means that, yeah, it's credited into your account, right? So I've got $229. So if the options expire worthless, I keep the full 229, all right? But what happens is that if the if after I sell the calls and the price goes up, if I want to buy the calls back, and of course if I buy the calls back at a higher price, I would lose money on this, right? But there's no reason for me to buy it back. I sold it, so be it. If it get called away, I'll just buy the shares back. So for me, I know the 229, right, belongs to me right now. So that's how I sell the calls. Now, so how did I go through the process? Let me just show it to you right now. I'll show it to you on Thinkorswim platform and on Interactive Brokers platform. Is that okay? So it doesn't matter which broker you use. So the first thing is to go to trade. Okay, and we're at Facebook over here. All right, and we want to sell the calls. Okay, and the first thing is to decide on the expiration date of your options. Again, 30 to 45 days is ideal. So as you can see over here, you have got all the different expiration dates. So I chose the 18th of April, 41 days to expiration. So that's the ideal one. Choose the one as close as possible. So click on that. Okay. So which strike price did I choose? So I chose the 180 strike. $180 strike. Okay, and the 180 strike, currently right now it's selling for $213. Well, it's $2.13, so it times 100 shares, right? So it's $213. So I got a slightly better price yesterday. All right, it was higher, and over time, again, as the options lose its time value, you can see that the price fall. So my job is to hope that it falls to zero, right? Because I sell it for $200, right? And if it falls to zero, that's the ideal situation. Remember, when you sell options, you sell high and you want to buy back low, or in this case, sell high and let it expire worthless. You don't have to buy it back. Okay. So to buy these, to sell these calls, okay, all you got to do is to click on. Now, first of all, how do I decide to sell the 180 calls? Like, why 180? Okay, let me just explain that. So the reason I decided to sell the 180 calls is because I don't think the price is going to get there in 30 days, right? So you got to sell it at a point where you don't think it's going to reach, right? It's above a resistance level, right? So I can see resistance at 172, and that's why I sell it at 180. Now, could I sell the 175 calls? Yeah, I could do that as well, but I think it's a bit risky because it may reach 175. It's a bit close. So I prefer to sell it slightly further out of the money so that it's less likely to reach the strike price and less likely for my shares to get called away, right? So it's really up to you. But of course, the further away the calls that you sell, further out of the money, you get less premium, okay? So there's always a balance that you have to decide what you're comfortable with, okay? So if I want to sell the 180 calls, where am I again? 180 calls. What I do is I just click on bid, right? Remember, when you want to buy, you click on ask. When you want to sell, you click on bid, right? So right click and sell. Sell the call. Now, this again assumes you already own the share. So you have to own the 100 shares, right? If you don't do this, right? So click on that and sell, right? -1 means selling one contract. One contract is 100 shares. Of Facebook, 18 April is the expiration date. That's the strike price, and this tells you how much money you are going to get. So in this case, if I sell it now, I'm getting $210. All right. If you don't like it, then wait for the price to be higher or demand a higher price and see if you get filled. So once you're ready, just click confirm and send, and the trade will be in. So that's with Think or Swim. If you want to place a trade with Interactive Brokers or any other broker, it's quite similar. So let me just show it to you how I do that. So using Interactive Brokers, again, you can use the app on the phone or the desktop. When it's a simple transaction, I can just use the app. So what I do is I just click on more here, more, order wheel, and I put in the ticker I want, Facebook. Click on options, and you select again the options that you want. So again, I'm selecting the April expiry, call options, strike price 180. Okay, and you can see that there are various ones, right? So so I decided to sell the 18 April ones, right? That's the one I decided. That. And they give you this wheel, which I don't like. So I'm just going to close the wheel. Okay. So there you go. Right now, the market is closed, of course. When the market opens, you would see the bid and ask prices. So if you sell, you would be selling at the bid price. Okay. In this case, it's 210. So what you can do is you can decide on the price you want to sell by scrolling down. Click sell, right? Click sell over there. Click sell. How many contracts? One contract. So again, for every 100 shares, you sell one contract of calls. Limit price. Put in the price that you want. So if you're happy with 210, put 210. If you're not happy, put 220 or put 230. Put higher if you want more money. But of course, you may not get it. All right. And then you could put good to cancel, which means let the trade run until it is filled or I cancel it. Once you're happy, slide this to sell and the order's in. All right, that's it. And anytime you want, you can always modify or cancel the order. All right. So that's what I've done. I have sold calls on Facebook shares to collect extra income while Facebook goes sideways. And again, the beauty of this is, when you own a stock like Facebook, even if it goes sideways for months, you're still making money from the dividends, although they don't pay dividends for Facebook, but other shares pay dividends, but you collect a premium by selling call options, okay? And I've also done it recently for another stock I own called Microsoft. So let me just show you why I did that. So again, you can see that I own 100 shares of Microsoft over there, and I bought it earlier on. Okay, so yeah, so I bought it somewhere about here. I bought it somewhere here at about 106. Okay, and you can see that there's a resistance, right? There's a resistance there. Can you see the resistance? So it went up and it hit 113 resistance and started coming down. So I thought, hey, I don't think Microsoft is going to go up for the next 30 days. I think it's going to go sideways or go back down again, right? So what do? I decided to sell the call options on Microsoft at a strike of 115. The 115 strike. Because I don't think it's going to get there in 30 days. So again, by selling these calls, I collect premium. And as long as the price doesn't go above 115 by very much, the calls do not get exercised by the call buyer. I'm not obligated to sell my shares. I keep the premium for free. All right. And if it does go to 116 and I have to sell my shares, that's fine, because I bought it at 106, I sell it at 115, I still make a profit and I collect the premium on the calls. So you can see that I sold. What was the price I sold it at? Let me check. Microsoft. Okay, so over there, this is the one. Okay. So I sold it at 174. So I pocketed $174 from the calls, and I sold it when the price was there, right? I sold it exactly there at the resistance, so I got $174. Okay, but since then you can see that Microsoft's stock price has come down a bit, so now the calls are worth less. Because when stock price goes down, call price goes down, right? So now the calls are only worth $1.19. Am I happy with that? Of course I'm happy, right? Because I sold it at 174, now it's at 119, right? Sell high, buy back low, or don't buy it back at all. Hopefully it'll go to 0. Yeah, and expires worthless, right? So that's how I sell covered calls on stocks I own that are hitting resistance. I don't think it's going up very much, going sideways. I sell calls, collect premium, and hopefully let the calls expire worthless. Alright guys, so this is a follow-up to the covered calls that I've sold on a couple of stocks. So the first one is on Facebook and the other one is on Microsoft, to name a couple. So I'm going to show you how I managed the trade. So the first thing is, let's take a look at Facebook. And well, I placed the trade on Interactive Brokers, and this is the app which I'm using. So again, you could have placed the trade on Thinkorswim. It doesn't really matter. I just have several accounts. This trade happened to be on Interactive Brokers. So just to show you, my Facebook position. So I've got Facebook, 100 shares of Facebook, as you can see, and I sold a covered call on these shares, which was the 180 call. All right, the 180 call, and I sold it a couple of days ago, I think about a week ago. All right, so let me orientate you to the chart. So let me orientate you to the chart. So I sold the call at a 180 strike price, right? So that's 180. So this is the strike price of the call, right? So when I sold the call, I collected a premium. Now let's check out what was the premium that I collected. So I'm just going to click on this to show you. All right, so there you go. So that's the average price which I entered this trade, which is 229. So what does that mean? Again, that means that I sold this call, which was the 180 call, I sold it at 229. So times 100, which means I sold it at $229. So that's the credit which I get from selling the call. Okay. Now, since I sold the call a couple of days ago, Facebook went down. All right. So again, these are shares I'm holding for the long run. So I'm okay if it can go to the short term. I'll just buy more shares because I'm confident that Facebook will go up in the long run because of the strong fundamentals. Right. So by selling the call, I've collected $229 in credit. Now, since then, the price of Facebook has gone down, right? So the call which I sold at 229, right now it's only worth 31 cents. Okay, so I've got two choices. The first choice could be I'm just going to let it expire worthless and say, you know what, it's going to expire worthless. I don't think it's going to get up there in the next. See, this call expires on the 18th of April. And right now it's the 19th of March. So there's still 30 days left. So in 30 days, if Facebook price remains below that 180, it will expire worthless and I get to keep the entire 229. But now, because the price has already dropped, you can see that the call that I sold is now only worth 31 cents. Okay, so what does it mean? It means that if I were to leave the call and let it expire worthless in 30 days, I will get the full 229. All right, but there's still a chance that in 30 days, Facebook could jump up and the call I sold could get in the money. All right, so if I'm pretty happy with what I have right now, right? So right now, I sold it at 229, and I can choose to buy it back, buy the call back at 31 cents. So if I buy back at 31 cents, what's my profit? There you go. My profit is $199. Got it? Remember, sell high, buy low. So if I close the trade now, I will realize the $199. Okay. If I keep it for another 30 days, I could squeeze another 31 cents out of it. So the question is it worth it? Is it worth to wait another 30 days to get a miserable 31 cents, which is $31? Or should I just close it right now and just realize my $199? So I'm deciding to just close the call, which means I'm gonna buy the call back at 31 cents, which is times 100 would be $31, which means my net profit would be $199. So once I've done that, I no longer have that call, which I bought it back, right? So what I can then do is I can sell another call to collect more premium. Does that make sense, right? So I'm going to do that right now. So let me just do that. So I sold this call. So to close the trade, I got to buy it back, right? So I'm going to click buy over here, buy, right? Buy, click buy, and I'm going to buy it at what price? Right now it's at 31 cents, so I could buy back at 31 cents. So put 31 cents and slide. Okay, so the order is in, and hopefully it will get filled in the next few minutes so that I will close that trade. And I can then very quickly sell another call to collect new premium, right? So I keep doing that and I keep collecting premium. Does that make sense? All right. So this is for my Facebook trade, for my Facebook covered call. Now for my Microsoft covered call, it's a totally different story. So let me show you my Microsoft covered calls. So you can see I own 100 shares of Microsoft. Okay, and I sold a call against the shares with a strike price of 115. Okay, so why do I say it's a different story? Because for Microsoft, instead of the shares going flat or down, the shares went up really strongly, and now the share price is above the strike price of my call. Okay, so what do I do, right? So good lesson to learn. Let's go Microsoft. Okay, there we go. So again, I sold the call a couple of days ago when it was somewhere here, where Microsoft was selling at about 110. Okay, so at that time I saw there was a strong resistance, and I thought to myself, I don't think that Microsoft is going to break above that resistance. So I decided to sell a call, right, covered call at a strike price of 115, which is somewhere here, 115. Okay, so I sold the call at a strike price of 115. All right, so again, by selling the call, I collect a premium, right? So what was the premium that I collected? Let's take a look. So this is the one, right? So we'll click on that. Okay, so I sold the call at an average price of 174. All right, so times 100 means that I sold the call and I collected $174 in premium. Okay, so now since I sold that call a couple of days ago, what has happened? Microsoft has gone up, and now it has gone above the strike price of 115. In fact, currently Microsoft is at 116.49. Can you see that? All right, so whoever bought the call from me, if he wanted to exercise the call, what would happen? I would be obligated to sell him my shares at 115. Now, if that happens, I'm okay with it because I bought the shares much lower at about $100 or something like that. I can't remember, right? So I bought it at $100. If I'm obligated to sell the shares at 115, you know, I make a great profit already. Plus, I get to keep the 174. All right. But it is unlikely that the buyer of the call will exercise the option right now, okay, because there's still time value left, right? So the option I sold again expires on the 18th of April, and now it's the 19th of March, which means there's 30 days left to expiry. So the person who bought the call, normally they would exercise the call when it's near expiry. So right now it's 30 days, unlikely that they're going to exercise the call, right? So what do I do in this scenario? So in this scenario, what I'll do is I'll just leave it. I'll leave it and see what happens in 30 days, right? Because again, in 30 days, anything can happen. So in the next 30 days, if Microsoft doesn't continue going up, right? It goes kind of like sideways or it goes back down, then what's going to happen? Then the call that I sold is going to expire worthless and I get to keep the $174, right? Now remember that the person who bought the call will only exercise the call if it's profitable to do so. Now, when is it profitable to do so? Think about it. The person who bought the call has the right to buy the shares at 115, correct? And the person who bought the call paid a premium of 174, which means that for the call buyer, his break-even price is 115 plus 174. Let me write that down. For the call buyer, his break-even price is the strike price plus the premium he paid, which is 174, which will be 116.74. Okay, so what it means is that in 30 days, if Microsoft's price stays below 116.74, chances are the person who bought the call will not exercise the call, and the call will then so-called be more or less worthless, and I will probably keep that premium. Okay, but if Microsoft were to go way above that price, Microsoft were to go to say 118 or 119, whatever it may be, then the call buyer would probably exercise the call, which means again I'm obligated to sell the shares at 115. Okay, when it's at 119. So of course I missed the upside. So I sell the shares at 115 and I get a cash for that. Plus I get to keep the premium of 174. And once I get a cash, what I can then do is to buy the shares back. Because ultimately, if I love Microsoft, I want to hold it for the long run. I still want my shares. I want to get it back, right? So if I'm forced to sell it at 115, I simply take the cash and just buy it back later on. So I could do that. That's another option. Another thing which I could do possibly is that if the price continues going up, all right, I could buy my call back. Now, of course, if I buy my call back, it's going to cost me money, right? Because I sold the call at 174. Okay, recall I sold the call at 174. But now, because Microsoft's share price has gone up, the value of the call has gone up to now 350. Can you see that? So I sold the call at 174. So if I buy it back at 350, I will make a loss of $175. Hence, you see this unrealized loss over there if I choose to buy it back, right? If I don't want to buy it back, then I don't have to pay for that. But if I want to buy it back, I got to pay for that. So another option could be, if I really don't want the guy to take my shares and it's nearing expiration, what would I do? That's right, darn it, I'll just buy the call back at whatever the price, okay? And because I sell at this price and I buy back at a higher price, I'll make a loss on it. But it's fine, because what I'll then do is I'll sell another call at a higher strike price to collect the premium to then offset the loss on this call, right? And we call that rolling your call. So rolling your call means closing your call option that you sold by buying it back and then selling another call at a higher strike price with a further expiration date, right? That's called rolling your covered call. So that's another option. So again, we'll see what happens because now it's the 19th of March, there's 18 days to expiration, and let's see what happens. Now in the meantime, remember that when you sell a covered call and the price goes up, there's no reason to be upset. You should be happy because you're still making money. And let me explain why you're still making money, all right? So this call which I sold, again, it's the 115 call. Now let me show it to you on the charts over here. $115 call, where is that? Okay, there we are, right? So this is the call I sold, which is the 115 call, and 18th of April, okay? Now notice, what's the delta of this call? The delta is 0.63. Can you see? This is the call which I sold, which means I'm short the call. So this means that for every $1 increase in Microsoft, what's happening? I am losing 63 cents. From this short call. But recall that I own 100 shares of Microsoft. So for every dollar increase in Microsoft shares, for every dollar increase in the price, the 100 shares will net me $1. Does it make sense? Okay, so let me repeat that again. I've got 100 shares of Microsoft, correct? So for every $1 increase in Microsoft, I'm making an additional $100 from my shares. But for every $1 increase in Microsoft, I'm losing 62 cents from the short call. Times 100, I'm losing, sorry, it should be 62 cents. I'm losing $62, right? Because you multiply by 100. So the net gain would be 100 minus 62, which would be, sorry, not too good mental maths. 100 minus 62 is $38. See what I'm saying? So again, for every $1 increase in Microsoft, as Microsoft goes up by $1, okay, I'm losing on the call 62 cents or 62 bucks in total, but I'm making $100 on the 100 shares. So the net result is I'm still making $38 for every one increase in price increase in Microsoft. So I should not be upset because of that. Now, as Microsoft price keeps going up, what would happen to the delta? The delta will go up from 0.62 be 63 delta, you may go up to 70 delta, 80 delta. Now, the moment it goes to about 90 delta, what does it mean? It means that, or if it goes to 1 delta, if it goes to 100 delta, for example, it means that when Microsoft increases by $1, my shares would gain $100, but this call would lose me $100, which means I'm not better off anymore. So that's the time I need to close my short call and to open a new short call at a further out of the money at a further expiration date to roll the call. All right. So essentially, this is how you manage covered calls once they're done. All right, guys. So we have just time jumped 24 days into the future, and it's currently the 2nd of April. So let's take a look at what has happened to Microsoft so far and what happened to my covered call that I sold. So since we last spoke, all right, Microsoft has continued going up, right? And in fact, it hit a high of $120, and as of yesterday, it closed at 119. All right, and remember that I sold a call at 115 strike price, right? So I sold a call at a strike price of 115. And again, what that means is that by selling that call, I'm obligated to sell my Microsoft shares at 115. But right now, Microsoft is trading at 119. And this call option that I sold expires on the 18th of April, which is in about 16 days. So once again, I have got two choices. The first choice I can make is I'm just going to leave it, right? If I leave it, what happens is if the price continues going up and the person who bought my call exercises the call, what happens? What happens is that I am obligated, I'm forced to sell my 100 shares at $115 and I'll collect the cash from there. And I'll keep the premium of the covered call which I sold. Okay, but I don't want to do that because I don't want to lose my shares. I love my shares. I like to hold it for the long run. Okay, so what I'm choosing to do right now is I'm going to choose to buy my call back. All right, so I sold the call. I want to buy it back, and of course I'm going to buy it back at a loss. Okay, because since I sold the call, the price has gone up. So has the price of the call. So I'm going to buy it back at a loss, but it's fine because I'm going to sell another call to collect more premium that's going to offset the loss of this call. So we call that rolling the call, right? So let's take a look at where the call is right now. And I'm going to use the Thinkorswim charting platform to take a look. Okay, so again, the call I sold is the one that expires on the 18th of April. Okay, this is the one, 18th of April. So there are 17 days left to expiration. And I sold the 115 call. So this is the 115 call. Okay. So let me just highlight that call. Right. So this call that I sold now has a delta of 80. All right, 80 delta. So again, remember, what does delta mean? So an 80 delta or 0.8 delta, which you can also call it 0.8, means that for every $1 increase in a share price, this call option increases by 80 cents. All right, but because I'm short the call, I sold the call, it works against me, which means that for every $1 increase in Microsoft, okay, I'm losing 80 cents on this call. Times 100, I'm losing $80. So let me repeat that again. So for every $1 increase in Microsoft price, this call that I sold is losing me 0.8 times 10 is losing me $80, right? But recall that I have got the 100 shares of Microsoft, right? So for every $1 increase in Microsoft price, my 100 shares are increasing by $100. So 100 minus 80 is $20, which means that it's still net positive, which means it still makes sense for me to hold on to my shares and the covered call, because net every dollar increase in Microsoft price, I'm still making money. Okay, of course I would make more without the done call, but it's fine. Okay, so the moment your delta gets to about 80 or 90 and it's kind of like just about a week left to expiration, you could roll the call. Okay, so in other words, what I intend to do right now is I'm going to buy the call back. Okay, I sold the call, I'm going to buy it back at a loss. So how much am I going to lose? So with that, I'm going over to my interactive brokers where I actually bought the call, or where I actually sold the call. Okay, so let me just show you the account. So this is my Microsoft shares, and again you can see I've got 100 shares of Microsoft, and that's the profit I have right now from the shares itself. Okay, so that is the call that I sold. All right, so I'm going to click on this call. So you can see that the original price that I sold the call was 174. Let me just highlight that, 174. Right, I sold the call at 174, and now the call is worth 460 because Microsoft share price goes up, price of the call goes up, right? So I sold it at 174, okay, and now if I buy it back at 460, what does it mean? It means I lose $288 if I close the call right now. All right, and the reason I want to close the call is because I do not want to be forced to sell my shares. Okay, so I'll be down 288. I'm going to do this the moment the market opens today. All right, but again, I'm fine with that. I'm fine with losing 288 on this call. Why? Because immediately I'm going to sell another call, which is further out of the money, that has more time to expiration, and I collect more premium that's going to offset this loss. So I keep doing that. So in a way, it's a no-lose situation. I can never lose on this strategy. Okay, So if the share price goes sideways, goes down, I get a call premium. The price goes up, I make money on the shares, and I can always buy back the call and sell another call. So again, it's a no-lose situation on this strategy. That's why I love this strategy. Okay, so which call am I going to sell once I buy this call back? Okay, so once I buy this call back and I take a loss of 288, I'm going to sell another call, and I'm going to decide to sell the call that has, again, 30 days to expiration, right? So I'll probably sell the May calls. So let me scroll down. Okay, there we go, right? So I'm going to then sell the 10 of May calls that expire in 39 days, okay? So which strike price should I choose? Now, currently Microsoft is at 119. Now remember that a share price can't go up every single month. It's got to, after going up really strongly, it usually will go sideways and go down. It's got to take a breather before going high up. So, it could go up some more in the next few days, but eventually it's going to, correct down. It always does, okay? So I'm probably going to sell the 119 calls. 119 calls that have a delta of 52. All right. And if I sell these calls, how much money am I going to collect? What's the premium I'm going to collect? Well, over here you can see the market price. Market price would be 375. There you go. So in other words, I close my current trade, I lose 288. Then I sell a new covered call, I get 375. Right? Plus, I've got another 39 days left for this call to expire worthless. So, net, do I lose money? No, I don't lose money, right? Because I get 375 minus 288, I still make $87, right? So again, not as much as I want to, but I still make money. I'm still green. I can't complain, all right? Now, at the same time, not only do I make money on the call that I sold, but at the same time, remember that I make money I also make money on the shares that I own. I own 100 shares of Microsoft, which means that ultimately as Microsoft goes up, I'm making more and more profits on that as well. All right, so that's the beauty of selling the covered calls of that.